Good evening. Welcome to the earnings review, your tidbits into company financials and operational insights. Thank you for joining us as we broadcast from Hampton Studios in Harare, Zimbabwe. I'm Ibn Mabunda, yo money man. On the show, we engage top echelon executives to get you up to speed with first-hand information. We also chat with the most competent analysts on the market just to ensure you are furnished with relevant and comprehensive market analysis. Tonight, we focus on Powerspeed, a listed concern on the Zimbabwe Stock Exchange, majoring in retail as well as the distribution of electronic products. Some quick facts where the company is concerned: its main units are engineering on a minor scale as well as the retail unit. Established in the 1970s as part of Mash Holdings, then a diversified group trading in the then Rhodesia, the operations of the entity have progressed over the years. A key development taking place, of course, in the year 1997 when Mash Holdings was unbundled. At that point, Powerspeed was formed, it being the result of the amalgamation of the industrial electric as well as minor units of Mash Holdings. In 1998, Powerspeed was listed on the Zimbabwe Stock Exchange. Now, on to how the operations are organized. It pushes its business agenda through three main units, which are the purchasing warehouse as well as the distribution unit, plus the industrial, which would be the engineering unit, as well as the retail unit, which is known by the flagship brand Electrosales and Industrial Electric. And to focus a little bit just on how Electrosales operates, this entity has over 19 units spread across the country with over 14,000 square meters of retail space. Powerspeed also supplies major retailers across the country through a unit known as the Electrosales Trade Center. Electrosales' main products would of course encompass hardware products including paint, plumbing equipment, as well as electrical gadgets plus building material. In Harare, the entity has over 10 operating units. Some quick stats where the group is concerned: with the current share price of 165 cents, the group has a market capitalization of over 587 million Zimbabwean dollars. Its share price has moved over 725% since the year started, vis-a-vis a 600% surge in the consumer discretionary index. Comparatively, the ZSE All Share has moved over 600% since the year started. Its key shareholders in the group would be the estate late Teneroy, the Powerspeed employees, as well as the ducting investments. Of major significance is the fact that the entity recently opened an Electrosales unit in Pomona as it seeks to expand its footprint across Harare. Persisting power cuts in Zimbabwe continue to pose a threat to Zimbabwe's power supply, resulting in a clientele interest in alternative sources of power. This, of course, continues to present opportunities for Powerspeed. Powerspeed has also been seeking to expand its footprint by adding a lighting unit, and headway continues to be made where that very section is concerned. In just a moment, we will have a chat on the operations of the entity, particularly its most recently published 2019 financials, with one of our very own in-house analysts. Stay tuned and don't go anywhere. Welcome back, viewers, and now joining me on the earnings review is our very own chief analyst, Respect Gwenzi. Respect, good evening and welcome to the earnings review.
Thank you, Eben. It's always my pleasure. Thank you.
Fantastic. Let's get the ball rolling.
Sure.
Before we get into the fundamentals of the group, I just need us to focus on their performance over the 6-month period to the 31st of March 2020. Just some highlights: their revenue jumping from 505 million Zimbabwean dollars to 717 million. Their operating profit increasing from 33 million dollars to 47 million Zimbabwean dollars, and their profit after tax jumping significantly from $21 million to 166 million Zimbabwean dollars. Just in a nutshell, what is your appreciation of these figures?
Yeah, of course, I think we have to outrightly, I mean, from the outset, to try to set a disclaimer in terms of the numbers, to say these numbers were prepared in inflation-adjusted terms. But I mean, looking at the way that hyperinflation is chewing into earnings, it simply means that, of course, those numbers have to be taken with caution. But I think when you're looking at the aspect of what were the key drivers of that performance, the basic underlying driver there was volumes growth. This is something that's almost unprecedented in this market, because the volumes that were achieved in the 6 months period from October to March were actually higher than those that were achieved in the prior year. So this was the major driver of this growth. But I think as well, when you then look at the impact of pricing, it gets to be a bit distortive, because sometimes you forgo your price in order to drive sales, and also you may not be beating inflation. You know, by failing to adjust your price in line with inflation, you're actually losing out in terms of core margins. But their operating profit was actually also higher, and also their costs were quite contained, which simply means to increased profitability. But more significantly, there is that increase in volumes, which I think is really attributed to an expanse in terms of their chain of their retail chain. They have quite been expanding that retail line over the past few years on reconfiguring their operating model. So I think, in a nutshell, they are starting to reap results of that, and they have been doing better than the average FMCG, where you find retail companies failing to push as much volumes as they were doing, say, in the prior year. So I think on the outset, the company achieved a very pleasing set of results.
I realize. Now, part of the results is a statement by the chairman, Dr. Simba Makoni, who said during this trading period, they realized that there was increasing demand for alternative forms of power, generators, solar panels, and all that, which they were not able to meet because of foreign currency shortages. What is your assessment of that very matrix there?
Again, this is an industry-wide phenomena. I mean, it started way back in 2016. Of course, slight improvements early into re-dollarization, or late into 2018 when we separated accounts, I mean, between the RTGS and the USD. The central bank has been failing to settle these obligations, and they've been accumulating over the years. So Powerspeed finds itself in that very same crisis, where they are failing to obviously meet in terms of their imports, part of their import bill. And it's an industry-wide phenomenon. But on the demand side, looking at the electricity generation numbers and the import, the volume of importation of electricity has really gone up over the past few years as well. So this really speaks to that growth in demand for alternative energy. And that space is where they come in, both from an engineering perspective and also from a retailing perspective. And that's quite the position there.
You mentioned the engineering unit. Over the past set of years, there hasn't been much activity going on in their engineering business. Particularly, this is the one that deals with the electrical motors and all that. What has been the driver of that downward trend where that particular unit is concerned?
Any kind of industrialization, it obviously demands importation of equipment. Primarily, we are looking at importation of mechanical goods, and therefore these are subject to availability of foreign currency. So anything that requires foreign currency in terms of production is really realized that decline. If you really see the way that they've changed their operating model, trying to source locally for most of the goods that they sell, it's really trying to run away from the aspect of having to source foreign currency. So I think this has been the major driver of weighing down, I mean, why their engineering side has really underperformed over the years. But it's one of the biggest engineering entities in Zimbabwe, but it has failed to really take off and produce good results because of the foreign currency challenges, and also the aspect of energy. I mean, power. I mean, we have not been producing enough, and they've really found themselves in a very tight spot.
Interesting. Now to get into the Electrosales, which is pretty much their flagship. They've recently been increasing their footprint, and now they've got 19 branches from 16 about 2 years back,
sure.
Which would perhaps be testament that something in their model is looking quite promising. How do you assess their growth in that regard?
If you look at the present numbers, the half-year numbers too much, I think they really speak to fruits from that initiative. I mean, trying to sort out your route to market, increasing your base in terms of your retail network. All those things get you closer to the market. And if you really look at some of the new branches that they have opened, if you look at the Westgate branch, the location is good. It earns them foreign currency. A lot of diasporans trying to push in money to build properties on that side of town. So I think they're making these quite strategic moves to increase their best in terms of the retail network, but also it really increases the best. I mean, it increases the customer base that you're dealing with. So they've really reaped results from this expands in terms of their network.
But what would be the logic where this very index is concerned? We're saying they have 19 branches across the country, 10 of which are in Harare. You have one in Pomona, you have another one in Semlevi, you have another one just nearby. I think about 3 clustered within one area. And in Harare alone, we're saying there are 10 units.
Yeah, I think that's over 50% of their branch network concentrated in Harare. But I think if you look at the quality of their products, they really up the value chain. So you are speaking to a customer base which has got the ability to pay. If you look at other smaller towns and the ability of those towns to be able to purchase goods on a high-end note is really low. So when you then look even at the dynamics around income, to just say how much income is generated in Harare relative to other towns at a national level, you realize that possibly over 60 or 70% of the income in this country is generated from Harare. So I really think it's an aspect of value. They do their study, their market study. They realize that possibly within a certain radius, the shop that they have in that space is obviously being overrun in terms of demand. Therefore, you might need to place another branch very close by. So I think those are some of the matrices, but it really speaks to the aspect of demand. You can't just place something in Torashanga simply because you want to widen the network. It's also a function of value. What do you derive by putting your branch in a certain space? But I think broadly speaking, it really speaks to the idea of having done a market research to say, is it feasible and what results does it give to us? But I don't have a problem in terms of the way that they have expanded their branch network to date.
I realize. Now let's talk about the pandemic and the effect that it has had on business. We're saying we are coming from very strict 21 days of national lockdown, which gradually have been eased up to this point. To what extent would the pandemic affect their volumes? I'm sure these results are right up until the 31st of March. So we are yet to get the feel of the progress from the 1st of April onward.
Yeah, but if you look at these results, they went on to highlight that business, they were largely closed for the greater part of April, and then they reopened. But looking at the volumes, they are actually rebounding. In fact, they actually say they're surprisingly rebounding to a level that they didn't expect, but they haven't really ascertained whether they would be able to restore profitability. The profitability levels. But I think what this really tells you is that demand has been strong. Just looking at the period January to March, things have not been as good from a macro perspective. If you really look at incomes, the way that they're being eroded by inflation, and then you find a company which really tells you that volumes are up, unless you are actually foregoing your margins, like I said earlier, to say maybe if your product is priced wrongly, people can actually chase it as a way of preserving value. But I really think that there's something good that they're doing in order for them to be pushing volumes at the way that they're doing. And right now, demand has obviously started to pick up again. But this whole thing about COVID, it's countrywide, it's global-wide. demand somehow has to be, I mean, it's actually affected. And if you look at how incomes are now being spent, you go for those things that are really quite important in terms of the value chain. And these are your basics. And therefore, you have to forego some of these capital investments like solars and so forth and so forth. But they have been able to hold their own, unless if their pricing is not good. I really think that they might actually be surviving well.
Looking at other factors, lastly, as we go, can you tell us how inflation could possibly affect their operations and also the persisting forex shortages as we get into their second half of the year?
Yeah, these are quite pertinent issues in this market, which is where they find themselves operating in. If you look at the fact that GDP for this year is likely to fall between 10 to 15%, and obviously coming from another 9 to 10% last year, this really shows you that there's not going to be any meaningful growth to particular businesses' numbers, including Powerspeed. So obviously, for the full year, I forecast that their volumes may not get back to those solid levels, and their half-year run, which they said was up on last year, it might suddenly be overturned. In fact, the biggest possibility is that these numbers will be overturned to become negative in terms of growth terms. So I really think that looking at the aspect of inflation, the value erosion that comes with it, and obviously this inflation coming from exchange rate, I really believe that it's going to be very difficult for them even to match prior year levels. So this is quite an industry-wide phenomena, but the good thing is they also have a bit of buffers in terms of their stock, and this might last them a bit of a mile. That's in terms of some of those goods which they have to source from outside. So in terms of supply, I'm sure they're okay, but what's worrying in this market is the demand side, to say, are you really able to are really able to attract the same kind of demand, because their goods are quite premium goods. And therefore, in a market where there's value erosion, you find consumers really trying to get those cheap Chinese products which they might source downtown or elsewhere. So I really think that it's going to be a tough time for them getting into this second half.
Well, thank you. Respect for the perspectives. Thank you, viewers, for staying with us. Don't forget to like, subscribe, follow us on Twitter, Facebook, and to visit our informative website, www.equityaccess.net. From the Equity Access team and I, Danke and ciao.